Before you close this video, I am not here to tell you Bitcoin is worthless. I am not here to tell you it has not made people rich. It absolutely has. Thousands of people have generated life-changing returns from Bitcoin, and I am not going to pretend otherwise. What I am here to do is make the case that the thing making those people rich is not what most Bitcoin advocates claim it is, and that the gap between what Bitcoin is sold as and what it actually is, in practice, is large enough and specific enough that calling it a brilliantly designed scam is not an insult. It is arguably the most accurate description available. My name is Tomas, and this channel is about finance, automation, and looking at every investment with honest, clear eyes, including the ones everybody is excited about. If you are new here, welcome. Hit that like button right now and subscribe so you never miss a video. Today, we are making the case against Bitcoin, the specific, evidence-based argument that the most enthusiastic Bitcoin advocates struggle to answer clearly. Let's get into it. Let us establish what the case actually is, because this argument is not about whether Bitcoin's price goes up. It is about what Bitcoin actually is versus what it is sold as. The promise versus the reality. What Bitcoin was supposed to be. Bitcoin was introduced in 2009 as a peer-to-peer electronic cash system. The original white paper by Satoshi Nakamoto described a currency, a medium of exchange that would allow people to transact directly, without intermediaries, without banks, without governments controlling the money supply. That was the founding premise. Digital cash, decentralized, borderless, censorship-resistant. A replacement for fiat currency built on mathematics rather than trust. 15 years later, almost nobody uses Bitcoin to buy coffee. Almost nobody uses it to pay rent. Almost nobody uses it as a daily medium of exchange for anything. The transaction fees during periods of high network congestion make small purchases economically unworkable. The price volatility makes it functionally useless as a unit of account. A store whose prices are denominated in Bitcoin would need to reprice constantly as the value swings 30% in either direction within weeks. The original promise, digital cash for the people, has not materialized in any meaningful, scalable way. What Bitcoin actually became is something entirely different: a speculative asset, a store of value narrative, digital gold. And the shift from the original promise to the actual use case is the first layer of the brilliance in the scam, because the new narrative was retrofitted to justify the price appreciation rather than emerging from any genuine technological breakthrough. The store of value argument, and why it is circular. Bitcoin advocates who have abandoned the digital cash narrative almost universally land on the store of value argument. Bitcoin is digital gold. It has a fixed supply of 21 million coins. Scarcity plus demand equals value. It is a hedge against inflation, against currency debasement, against the irresponsibility of central banks. This argument has a specific problem that rarely gets examined honestly. Gold's store of value properties come from millennia of established utility, jewelry, industrial applications, a cultural consensus built over thousands of years of human civilization. Bitcoin's store of value properties come primarily from the belief that other people will also believe it is a store of value. That is not scarcity creating value. That is a consensus narrative creating price, which is a fundamentally different thing. When a significant portion of the people holding that consensus change their minds simultaneously, the price mechanism that depends on them does not behave the way gold behaves. It behaves the way speculative assets behave when the narrative shifts. The network effect argument, and what it actually proves. The most sophisticated Bitcoin advocates point to network effects as the mechanism that makes Bitcoin's dominance durable. Bitcoin has the largest network, the most security, the most institutional adoption, and the longest track record. And they are right that network effects are real and powerful. But network effects in monetary assets do not guarantee permanence. They have historically lasted until a superior alternative reached critical mass. The Roman denarius had extraordinary network effects until it was debased enough that alternatives became preferable. The British pound had global reserve currency status for over a century before the dollar replaced it. Network effects create moats. They do not create invincibility. The brilliance of the design, why it is a scam that genuinely rewards early participants. The structure that produces those winners is identical to the structure that produces winners in any asset where later entrants fund the returns of earlier ones. The early buyers benefit from the narrative reaching new audiences. Each new audience that enters at a higher price funds the exits of those who entered earlier. The asset does not need to produce anything. No earnings, no cash flow, no dividend, no underlying economic activity, because its price appreciation is self-sustaining as long as new participants keep arriving who are willing to pay more than the previous participants paid. That structure is brilliant. It is also, by most definitional standards, the structural description of a greater fool dynamic, not a fraud in the legal sense, but a system where the return to any individual investor depends primarily on finding a subsequent investor willing to pay more, rather than on the underlying asset generating economic value. The honest counter-argument, and why it does not fully resolve the issue. The strongest counter-argument to everything above is this: gold does not produce cash flow either. Art does not produce cash flow. Collectibles do not produce cash flow. And yet these assets hold and create value through a combination of scarcity, cultural consensus, and the self-reinforcing belief in their worth. If Bitcoin has achieved a sufficient level of institutional adoption, regulatory acceptance, and cultural permanence, the greater fool dynamic eventually stabilizes into something that looks more like a genuine asset class. That argument is worth taking seriously, especially in 2027, where Bitcoin is held in institutional portfolios, traded on regulated futures markets, and accepted in various forms as legal tender in multiple jurisdictions. The legitimization process is real. The question is whether that legitimization is durable enough to justify the valuation, or whether it is simply a more sophisticated version of the same narrative-dependent price mechanism that has characterized every previous Bitcoin cycle. The answer to that question is genuinely uncertain, which is exactly why treating Bitcoin as a validated, reliable store of value rather than a highly speculative bet on a narrative continuing to find new believers is one of the most financially illiterate things an investor can do without acknowledging the specific nature of the risk they are taking on. So here is the case in full. Bitcoin was sold as digital cash and became a speculative asset. Its store of value argument is circular, value derived from belief in value rather than from underlying utility. Its network effect moat is real but not invincible. Its structure rewards early participants through later ones, in a pattern that is indistinguishable from a greater fool dynamic, until and unless institutional legitimization makes it something more durable. And the honest counterargument, that consensus-based assets can hold value if the consensus holds, is real but does not resolve the fundamental uncertainty. Bitcoin may continue to be brilliant for people who understand exactly what they are buying. The problem is most people buying it do not. And not knowing what you own is the most expensive form of financial illiteracy available in 2027. If this video made you think about Bitcoin differently, agree or disagree, please hit that like button. It genuinely helps this channel grow. And if you are not subscribed yet, click that button right now so you never miss what is coming next. See you in the next one.